Welcome to Cash Flow Theory. Today we are going to talk about stocks and bonds. These are the main two mechanisms used by companies to raise capital. So if you're planning to become an investor, it is really important to understand the differences in stocks and bonds. So Charit is with me here today. So without further ado, let's get into the discussion. So Charit, what are the differences when it comes to investing in stocks and bonds? And what are the risks that are involved when we're investing in stocks and bonds?
The difference between the stock and the bond is that those are the two mechanisms that company raise capital, right? So when you're raising the capital, if you want to sell a part of your company, that we use the stocks to raise the capital. And then if you want to get something as a loan, and then that is called bond, that you can sell that part and then you can raise the capital. So that is the difference between stock and the bond. So the risky part is when you're investing on the stock, that you own the ownership of the company. So if the company is doing well, the stock price will go up. But if the company is doing bad, you will lose money on that, right? And depending on the stock price fluctuate, right? It's not the public traded company, I'm talking about private company as well. Same thing. And then if you're talking about the bond, so you have the maturity level, right? So that you will guarantee to get your cash back, and as well as some kind of interest that you will get it, right? So to get the clear picture on how it works, so let's go to the whiteboard and then I'll explain what is the part of the asset and what is the part in the liability section that you can create in difference between the stock and the bond. Before I go into the stock and bond, so I'll explain what is in my previous video. If you click below, you can understand what is a financial statement and all that. So on that financial statement, I'm going for a financial statement called balance sheet, which has assets and liabilities, right? Okay. So what it does is, if you wanted to sell part of the company, so which is assets, right? So whatever that one. So let's say you have, for example, you have amount like 10,000 worth of assets, for example, right? So what it does is you package it up, all these shares, all these assets, and then distribute it into equal shares, which is, for example, if you say 10,000, so I'm going to divide this one into 1,000 shares. I'm going to issue 1,000 shares, which is at $10 each share, right? So you have thousands. So based on the company performance, this can go up and this can go down, right? So this is the piece of the company that you're getting, and so that is, we call it stocks, right? And then let's jump into the what is bonds. So bond is a loan that the business is getting, and let's say you have a loan of 20,000, right? And so on that loan, what you're trying to do is you're going to package it up, and then you divide those 20,000 into 2,000 pieces, and you're selling one at $10. But for that, hang on, for that you guarantee interest to pay for the bondholders, so which is, let's say, 3% or something, right? So on the maturity, you're paying back the loan amount, as well as you're liable to pay some kind of interest or the compensation, right? Okay. And on this occasion, so on the asset side, if the company is making a profit, you're liable to pay some kind of a dividends or profit sharing for those asset holdings. So that is the primary difference between a stock and a bond. Right. So one piece from the assets column that you're getting, that we call it stock. One piece of that you're getting from the bond, and then which has maturity level, and that we call it a bond. So that's about it. So this is basic stuff on what is the difference between a stock and the bond. If you like this video, please subscribe on the bottom and then thumbs up, and we'll see you on next video.